Hello and welcome to the BasisPoint Insight interview. Today we are joined by someone with a deep and seasoned view of India's financial markets, Manoj Rane. He brings decades of leadership experience having headed global markets businesses at both Indian and multinational banks. Beyond the trading floor, Manoj has also helped shape market policy through key roles at industry bodies such as FEDI and FIMDA, where he served as vice chairman. In this conversation, we'll get his take on the big shifts we've seen recently, from currency movements and interest rates to equity markets and the evolving regulatory landscape. Well, welcome, Manoj, and let's just dive right in.
Thanks, Ranjana, for having me on the show.
Yeah. So let us start with the currency markets. The rupee has strengthened against the dollar in recent weeks. Why has this happened? And what are the key drivers at play? Also, we'd like your expectations for the currency pair in the coming weeks.
Whenever one asks a question about INR weakening against the US dollar, uh, someone famous who will go unnamed once said that it's dollar strengthening, not INR weakening.
Yeah.
But I mean, let's get a little beyond that. It's interesting because there have been really two key drivers for the INR weakening that happened, in the early part of this year, uh, where the currency moved from 82, 83 all the way up to 88 against the US dollar. So the two key drivers at that time were that there were large outflows on the FPI side, so almost $22 billion over 3 or 4 months, and this was bound to tell, particularly in a country where we are a little shy of on the trade side, on the current account side, we are still significantly negative, and FDIs, as has been brought out, have been very slow for the last year, considerably less than the year prior to that. So that part was well known that these outflows are going to hurt. The second thing is, which not too many commentators really talked about, and that's why my first comment about dollar strengthening was that the dollar index had moved from almost 100, which is like par, to 108, 109, which means that the dollar had considerably strengthened against all the major currencies. And it was bound to tell on our currency as well. And, there was no doubt that this was having an impact. This was actually in the lead up to the US presidential elections. And there was a very bullish sentiment for USD. The fact that US economy was doing extremely well. The rates in the US were expected to come down. It's a lot of flight of capital from emerging. So these were the two major reasons why the currency strengthened. At that time, weakened, dollar strength. Later on, in the last couple of months, maybe a month really, the currency has bounced back fairly sharply. Again, there is no surprise here, because if you follow the dollar index is again down to 99.6 or something like that, the last level. So if it means that the US dollar is weakened against most currencies in the world, and again, no prizes for guessing why, because of all the uncertainties that the new President Trump has thrown US markets and global markets into. And the second factor, of course, is that some amount of FPI buying has come back. So you've seen about 2-3 billion odd dollars come back to the market. And that has also resulted in, firstly, I mean, of course, we'll talk about stock markets later, but it has indeed helped strengthen, the INR over that period. So it came strengthened all the way back to 83. Right now, it's at about 84 and a half or so. I expect it to hold, in this range for some more time, for at least for the foreseeable future. But of course, the long-term forecast for INR versus US dollar is of a gradual weakening, given the interest rate differentials and given the fact that we remain principally a current account deficit country.
So, speaking of equities, the market has seen a sharp comeback after the steep fall. So, what's driving this rebound, and what are your expectations, in the coming weeks?
Uh, After I'm of the old school, so I track
Hmm.
Sensex more than I track the Nifty, and we did see the Sensex go all the way up to 80, 85, 86,000 at the top,
Yeah.
and then in the largely led by the large FPI selling of $22 billion that we spoke about. Yeah, 20, we did see uh, a lot of fall, I mean sharp fall in index because there wasn't too much supportive buying here. Again, it was also a bit on sentiment because there was a lot of uncertainty brought in by whatever was happening in global markets. So you saw the index come all the way, Sensex come all the way down to 72,000. So, and from 72,000, after the large FPI selling petered out, and I think some amount of sanity returned to markets. Also, some positive conversations. Even you would have noticed that the Dow Jones Index itself, after a very sharp fall, based on, or on the background of whatever was happening, relating to Trump's tariffs and other actions, it has almost retraced more than 60% of the fall that we had seen in the Dow Jones. So it's not a unique India feature that stocks have bounced back to the extent that they have. However, uh, the fact is that not too much of fundamentals have changed. So, one would advise investors to be cautious at this level because, there are headwinds on all sides, and apart from global uncertainties relating to economic trade related uncertainties, but also relating to, geopolitical uncertainties. And, every day there is something or the other happening, which is not such great news. So I think it's not really time for euphoria that suddenly you're going to see a 20% appreciation from here. So I think people should indeed watch out from here, if as far as positions in equity markets are concerned.
Yeah, some word of caution. No,
Yeah.
as you say, just there's no time for euphoria as yet. So moving on to monetary policy. So our new RBI Governor Sanjay Malhotra has delivered a couple of rate cuts early in his tenure. So what's your reading of this move, and where do you expect rates to behave going forward?
Uh, it's interesting because around the time the new governor, Mr. Malhotra, took charge, at that time there was a acute shortfall or shortage of money in the system. So almost 2 lakh to 3 lakh crores of rupees. And my our foreign viewers will pardon me for using lakhs and crores, but I find it very difficult to convert to billions. Uh, we'd better do some reading or use ChatGPT. In any case, given that level of currency shortfall or liquidity shortfall was there in the markets, there was a clamor from banks to provide liquidity. And apart from what the actual rates were, the availability of money itself created a lot of friction in terms of banks willingness to lend, and that itself acts as a very massive dampener for growth, because if corporates are starved of liquidity, then it's going to tell on growth. So I think when the governor came, he had a very clear mandate that and he came from the finance ministry, right? Like someone said, he took a flight from Delhi and changed into RBI as soon as he landed here. So that has happened to previous governors as well.
Yes,
But I think
yes.
he came with a very clear mandate that he had to look at how to get rates down and how to ensure that liquidity was not short anymore. So multitude of measures happened successively, very strong measures, right from injecting liquidity into the market by means of repos and long-term repos, uh, buybacks of securities, etc. To the extent now, for now, the market is almost flooded with liquidity, and at the same time, we had a couple of interest rates cuts. So when he arrived, it was 6.5% the repo rate. Now it's down to 6%. And interestingly, I think one benchmark which you should watch to get an idea of what's happening on rates is the 10-year government bond yields. So 10-year government bond yield was at about 6.9 when he would have arrived. It's down to about 6.25. So you've seen a fall of almost 65 basis points. With a 50 basis point rate cut, a 65 basis point fall indicates two things. One is that at that time, interest rate expectations were not great. People expected interest rates to go up. So that those have now reversed, or at least there is expectation that there'll be some more cuts. So that's getting priced into the 10-year bond, let's say. And the other thing is that with interest rate with 10-year down to 6 quarter, it means that the market believes there will be, of course, further rate cuts. Also, that there is now reasonably efficient transmission of rate cuts happening, which
Yeah.
wasn't the case as soon as the first rate cut happened. So everybody was saying rate cuts have happened, but not telling in terms of deposit rates, not telling in terms of lending rates, and so on. So I think these two are very positive, but I think the underlying message which possibly gets missed in all this is that inflation has come down significantly. So the last 3 months, inflation has continuously ticked below 4%, which is RBI's, if we note that it is there at the lower end of their long-term corridor of expectation, and that itself will mean that there is enough elbow room for RBI to cut rates going forward. So I'm fairly bullish as far as interest rates are concerned. And when you're bullish on interest rate, it means it won't go up; it will come down. So I expect that you will see some further rate action as time goes by, and we will see more liquidity, lower interest rates, and hopefully it will translate into better growth going forward.
Lastly, we'd like your quick view on the regulatory space, and I would specifically talk about the recent SEBI action on IndusInd Bank. We've seen you extensively write on the matter, very strong views. So tell us, what do you make of the way this issue has unfolded?
Uh, Not many know, but IndusInd is quite dear to me because I was one of the first employees of IndusInd Bank 3 decades ago when it started. In fact, I joined the bank even before it started. It kind of put up its shingle before that. So uh, it is dear to my heart, and the goings on there have been nothing short of depressing. I wouldn't even say disappointing. So, I have written extensively, like you said, and a lot of the stories still needs to be told because not much has come out in the public domain. From an initial clean chit with Reserve Bank gave the bank, which was a bit of a surprise to everyone because it was done too fast. There have been fairly, a little bit of stuff rolling out, some action against the senior management, and then now the latest, SEBI fines and action again against senior executives. Uh, I think what sometimes gets missed in all this is that whenever such an event happens, typically executives are blamed and action is taken against executives, and everyone thinks it's business as usual and we are back to work as usual. But I think what regulators, particularly, and also bank boards and managements need to closely look at when they have this opportunity is who in non-executive roles was supervising what the executives are doing. It's not enough to say that I don't have anyone in the board who does not understand. I mean, who understands derivatives or who understands FX. But then why don't you have who does? Because these days derivatives, trading books, hedging books, these can considerably affect positively or negatively your balance sheet and your P&L. And apart from that, it can, of course, hurt your name very badly, your brand, as you've seen in the case of IndusInd. So I think it's very critical that regulators look at it very closely, and it's important to make it in some way mandatory because all you need to do is just go on any bank's website and look at the board of directors. And I'd be surprised if it gives you confidence that anyone in the board, and I'm saying this with a lot of responsibility, that anyone in the board has a has a grasp of what's happening in the dealing room, or in the markets business of the bank, or in any of the risk functions of the bank. And that's where I think it's highly risky because the executives, the senior executives, are incentivized by the amount of money that the bank is going to make. So they're bound to take risks. When the risks go against them, there could be a temptation if there is no one supervising them or no one who understands the business. There's always the risk that there'll be a temptation to sweep things under the carpet or keep them hidden as far as possible or as long as possible. So my message here is more big picture. The system needs to take every such opportunity that it gets, and I have had lots of conversations with many other banks and the question has been at very senior level how to avoid such a bomb going off in our bank. And I can, these are the exact words. It's not come from one senior guy, but many senior guys. And according to me, this is the only way because otherwise, history will keep repeating itself.
Yeah, indeed. Manoj, now we'd like to wrap up and thank you so much for those sharp insights across the board from currencies to credit policy, the capital markets, and the banking system. And it's clear we're in a very dynamic phase, and voices like yours help cut through the noise and bring clarity. So we'll be closely watching how these trends evolve. And thank you once again for your time, Manoj. Thank you.
Thanks a lot, Rajan. Pleasure. All the best. Cheers.